Oh, it's risky. If we do this real estate thing, this can be risky. Have you thought about the risk associated with real estate? All right. There's risk associated with different types of real estate, yes. Now, there's also risks not doing real estate at all. But real estate is literally the number one way to build lasting wealth if you do it the right way. So if you want to scale your real estate investing and want to know about the risk associated with different assets, asset classes, different strategies, then this video is for you. So today I'm going to talk about risk in different real estate strategies, flipping, BRRRR method, mobile home parks, that kind of stuff, multifamily, and how to handle the risk, what those risks are, how to handle them, and then which asset class right now and historically has the least amount of risk. Let's do this. You know, a lot of us read Rich Dad, Poor Dad, right? And we got this real estate thing in our brain. We got passive income in our brain, financial freedom in our brain. But the book is kind of silent on really how to do it. What exactly is a strategy that gets you to the promised land of financial freedom, of wealth, generational wealth, and things like that nature? And most of us gravitate towards single family house investing, fix and flips, BRRRR method, short-term rentals now, even co-living, that kind of thing. But the truth is, and you may know this, that doesn't actually lead to financial freedom. And one of the elements of that is the element of risk. And I want to talk about this risk right now. One of the problems with single family house investing, which we're not going to go deep on in this one here, is it's not really scalable. It's not really that passive. And so I flipped 3 dozen houses, and I didn't understand it until I got done flipping 3 dozen houses. So it's actually not very passive. It's actually a lot of work. If you're not buying, fixing and selling houses, you're not really making any kind of passive income, right? And so how do you scale that? How do you scale rentals? Rentals makes $200 per month in passive income, maybe if you're lucky, assuming your tenant doesn't move out and you don't have to put a bunch of repairs into it. And so if you want to replace $10,000 in income, you need a lot of rental property. So it's very difficult to scale. And so doing commercial real estate, for example, where the numbers are bigger, where you can hire a professional manager, is actually much more scalable, much more passive. This is one reason I like multifamily as well, but it's not the only reason I like it. I want to talk about risk in real estate in general, because what I don't want is I don't want to work 5-7 years on something, work really hard and building this wealth vehicle, this platform to build wealth on top of, and then all of a sudden it goes away. It goes away through things I can't even control. Some like a recession happens or some legislation is passed or whatever, and now it's gone. And so I want something that I can build wealth on long term, so that I can actually have the runway to build wealth on top of that. And maybe I want to actually give it to my family and my children and use it as a platform, right? Because we all agree probably that real estate is one of the best ways to build wealth on top of. But which one? And the problem is we always gravitate to things that we see on TV or that maybe know someone does, and that's single family house investing. But let's talk about the pros and cons of guys. There are pros and cons, and I want to focus on risk. So let's talk about flips here, right? Flips I like because it generates these cash, these chunks of cash, and I'm only holding something for 6 months, so my exposure to market level risk is much more limited. Even if the market were to go down, it typically doesn't crash in 6 months. Now, it sort of happened in 2000, but even that happened a little bit more over like a 12-month period. So if I'm holding a flip, okay, not ideal, but I wasn't devastated, versus if I'm doing a buy and hold, which was devastated. So I'm not exposed to that. I am not exposed to the single tenant risk of having a tenant and that person moving out. Now I got to cover all the costs. So I do like it from that perspective. I don't like it as much because it is relatively easy to make mistakes. I can overestimate the ARV, the after repair value. My contractor can go over budget, take longer. If I'm using a hard money loan, for example, now I have to start paying points and penalties on top of that. So to me, that's a risk on the fix and flip side. Now on the rental side, I don't have some of those other problems, right? The BRRRR method, but I do have a single tenant risk. If that one tenant moves out and it takes me a little longer to fill that, now I'm paying 100% of the expenses, including the mortgage. So I don't love that. I am much more exposed to the market. And we saw that in 2008, and I did not love that. I knew people personally who not only lost their houses, but in some cases, huge portfolios that they spend 5 to 7 years building up, and then all of a sudden, boom, it was gone because of the recession. And again, I don't like that. I want a platform that is going to be around for long periods of time. Short-term rentals. Now, I did like short-term rentals. I really did. 5-7 years ago, man, it got really close to like the aspects of multifamily commercial real estate investing. But the gravy train kind of stopped about 3 years ago. I had a good buddy of mine who has a substantial short-term rental portfolio, and he started reporting 3 years ago about his income started going down to the point where it went into the red, and he's now desperately trying to sell his entire portfolio, or at least the majority of it. And so I don't like the fact that people now got so much into short-term rentals that the supply really increased, and it's no surprise, right? I mean, if everybody's printing money out of their short-term rental, it attracts all kinds of people into real estate that they were like, oh, I'm on the fence, I'm not going to do this, and now they're into it. Now, I still like STRs because but you have to buy right. You really have to study the market. You have to get very sophisticated. There's some sophisticated market and data analysis tools out there that you have to take advantage of to try to estimate the market and the saturation and the potential for saturation. So even if you get into it, you might not have a 10-year runway, but you might have a 5-year runway, for example. So you got to make sure that you kind of know what you're doing and you're buying right. But again, yeah, you're not subject to the single tenant problem because you have multiple tenants. You are subject to the market, though, right? If the market goes down, it's not like a commercial real estate property where I can try to increase the income of it and maintain or even grow the income. Though has changed in some parts. Some lenders will actually give you a loan based on the income of that. It's called DSCR, debt service coverage ratio, which is commercial real estate loans. So it has already started to change. So I do like that about STRs. But you've got to know what you're doing because if not, you could be subject to saturation. Also, there's a little bit of a legislative risk here, as we saw in New York City. All of a sudden, New York City decided that, oh, you know what, this STR thing, that's very bad. And thousands of investors were left holding the bag thinking they can rent it out for X, and now all of a sudden it's only worth Y. And I don't like that. I don't like that at all. So there's still some of that, though I think it's been around for so long that it's probably controllable and manageable. Again, you got to know what you're doing, and you have to look for markets that are friendly to STRs. Now, speaking of other legislation, I do like pad splits, co-living. The risk there is legislative because it's so new that many cities, counties, whatever, haven't actually passed legislation on it. We do know that you don't want to buy co-living pad splits into HOAs because HOAs are like, nope, I don't like people coming and going. Not for me. That's not why we created the HOA. So that's already the best practice, not to buy in HOAs. But again, here's that legislative risk. So you buy a couple, pad splits or co-livings, and you can actually put a relatively sophisticated property manager in there, and that's pretty cool. And then a year or two from now, some legislation is passed that prohibits the use of co-living. So be careful for that. Again, that's one of those things where outside of control, things happen in your market, and now your investment vehicle goes away. And so now we're kind of like in commercial real estate land, and I do like a lot of things about commercial real estate, and we'll talk about commercial real estate in general because some of the risk depends a little bit on exactly which kind of commercial real estate you go into. So let's rattle off a few. I do like mobile home parks and self-storage. They have proven over the decades to be relatively recession-proof. We saw that in 2008. A mobile home park's very affordable place to live, always in demand. Self-storage, always in demand. And so I like that. Office used to be really cool until COVID, no longer cool. And now it's still very cool. So I don't know when that's going to recover either. Retail, I always do like retail, but it got hammered pretty good in 2008 in the last recession. And so a lot of people in retail really did not recover from that. So I didn't love that. The other recession resistant asset class is multifamily, especially in 2008 when the real estate market really got hammered pretty good. Rents were obviously flat, vacancies eased up just a little bit, but the demand for affordable housing was still there in 2008. People need a place to live. And so again, with COVID, people paid their rent. So I really like the way multifamily behaves in down markets. And we saw what happens in up markets, especially in inflationary environments where rents went up by 25%. And it was wild. The valuations were driven up as well. So I like the way that multifamily behaves in down markets. I also like the outlook of multifamily, the longer term demand, because you can't build affordable housing. And so we're in this place right now where it's too expensive to build something for $1,500 to rent, right? I can only build Class A luxury, and it's too expensive to build right now. So the permits are down by over 50% over the last 18 months because the interest is too high, right? And now we have tariffs on top of that, and now our construction costs are going up. And so it's not likely that people are building anything new in the next several years. So what's that going to do to rents? It's going to make those rents go up. So I do like the long-term outlook with multifamily. I like the way it behaved over the decades. There's really no chance that legislation is going to be passed that will outlaw multifamily. Obviously, it's been around for decades. So what I'm saying is, to me, all commercial real estate in general, also look at some of the other asset classes I talked about. To me, most people gravitate to multifamily because it's more familiar, right? Versus, for example, mobile home parks or self-storage, not as familiar. And so this is why residential housing is very familiar to them. And so to me, that's why out of all the real estate, it really makes the most sense and to get into multifamily, right, is because it's less risky, right? You don't have that single tenant risk. You're not as subject to market level risk, and you have a very long outlook, a lot of demand for the asset class. So really have a lot of things going for it as well. Now the only question is, well, how can I get into multifamily? And we cover that in a lot of other videos as well. But the good news is with multifamily, it's actually easier to get into than you might think. In fact, you don't need to invest in single family to get into multifamily. It's not like a stepping stone, because the things you do in single family actually don't really directly help you in multifamily. Instead of having a bunch of experience, you're going to learn a variety of things that weren't even on your radar, like building a team around you, for example, building a team around you and then using and leverage that team's track record to make you look experienced as well. And we're not using our own money anymore. When you're getting into multi-million-dollar real estate, very few people have enough money. Even if you do have money, you're eventually going to run out. So what do these people do? They raise money. It's called syndications, right? So if you haven't heard about syndications before, then just learn more about syndications on our channel. And it's really a fantastic way to get into larger real estate. Also, I think we're in a very, very unique time right now to get into multifamily specifically. Like, for example, just 2.5 years ago to now, right? And there's this narrow window that's starting to close, but it's really important you understand this. Back in 2020, 2022, the relative risk in multifamily was much higher. Again, multifamily is on the very lower end of the risk spectrum of real estate in general, but within that spectrum, 2.5 years ago, we were on the higher end of that low end spectrum because, for example, we got a lot more leverage, right? So lenders gave us a lot more leverage. We were able to borrow against not only the purchase of the property, but also against the construction. And it was great, right? But everybody knows the higher leverage, the higher the risk is. And so now with the interest rate hikes, that created problems for some operators who had, for example, floating rate debt, which is typically used to buy heavy construction value-add deals. And that's created a problem for a lot of the operators as well. Now, for example, in 2025, right, we're getting much lower leverage, and you're not getting any kind of loans on construction anymore. It's only for the purchase of the property, and you're getting no more than 75% of only the purchase of the property. So number one, the leverage is lower. Number two, hardly anyone is using floating rate debt anymore. So all is fixed rate debt at this point right here. And as a result, prices have contracted by 30-40% over just 2.5 years ago. And so what we are, I think 2.5 years ago, we were in a bit of an unnatural market, very high leverage. The prognosis for interest rates was higher. And now we're in a relatively stable market with high interest rates, but that's okay. Right? It's much more stable. And so I think what's going to happen is we have this rare environment where people are not, the appetite for multifamily is relatively low, which means that the probability of getting deals done is much higher. In fact, we're seeing that. We're seeing a much more deal flow right now. You're not paying deposits that are non-refundable. We're not having prices above asking. It's a very balanced market, almost in favor of the buyer at this moment. So take advantage of that. Also take advantage of the relatively low risk that we're getting into. Deals are getting done with very low leverage with fixed rate, right? 2.5 years ago, we would have lost deals sometimes if we didn't take advantage of some of those things. So right now, to be competitive, all we have to do is take advantage of doing what's now. So we're relatively low risk, and we have these rents that are going to be rising here probably in 2020, this year and early in 26, because no more building is being done. So we have this, I think, a 12 to 18 month window where we can really get in here and buy real estate at relatively low risk, a relatively low price with a very strong outlook. So if you want to learn more about multifamily, then check out our Apartments 101 Masterclass. We kind of walk you through how this works, how to raise money, how to build your team, how does syndications work, and what is the structure of those syndications. And so check that out if you're interested in getting started with multifamily. But this is really why I think multifamily is the best asset class right now to get into. And hopefully you were inspired in that to look into more, take the next step, learn more about apartments and syndication. Catch you next time.